Hello and welcome to our Financial Literacy Education series, where we help you get a better understanding about your money, become more engaged with your money, and make better decisions about your money. My name's Corin Jacka. I'm from Priority One Wealth Management Group. So far in our series, we've covered off why you need to understand your money, getting good advice, managing your cash flow, which is a really important foundation of wealth creation, because that's where we understand what surplus money we might be able to obtain. And with that surplus money, we went through the wealth creation options you can do in relation to saving money in your own name, debt reduction, superannuation, and gearing. Today, we're going to focus on managing your assets. So managing your assets is about looking at where you then invest the money. When we've looked at our wealth creation strategies, investing in your own name, superannuation, or gearing by borrowing money and investing, this is the next decision. Once we know what strategy we're doing, we then need to decide where are we going to invest our money. Are we going to put it in cash, fixed interest, property, shares? So today we're going to look at a philosophy that helps you understand what you may expect to get in relation to the return you might get on a particular asset class or a particular portfolio. Just a bit of background on the approach we're taking today. What we're looking at today is trying to understand what an asset class is going to do over a long-term period, so 10 years plus. So if you think of something like superannuation, or even a lot of long-term investments that you make in your own name, this is the kind of time frame we're wanting to take. The reason why we're looking at 10 years plus is, one, it's actually better to get an understanding of what an asset class is going to do over the next 10 years than it is to try and understand what a market's going to do over the next 10 days, 10 weeks, or 10 months, which is much more affected by short-term sentiment, and the long-term is much more impacted by fundamentals. The other reason why we're focusing on asset classes today too is over that time frame, that 10-year plus time frame, most of the returns you're going to get are going to be attributable to the asset class you select. A small percentage return you're going to get is going to be attributable to the individual investment you make, and an even smaller percentage is what you're going to get in relation to when you buy and when you sell. So whether we're buying Commonwealth Bank or BHP this week or next week becomes less important over that longer term. The more important question is, should we be buying Australian shares in that case, or international shares, or another market, property, fixed interest, or cash? Now, in this approach, we look at the three areas that make up the return you're going to get when you make an investment. So the three areas you're going to get a return from are the income you get. So if you have a property, it'll be rent. If you have shares, it'll be dividend. You'll have the growth in that income. So the rent can go up. The dividends will usually go up in line with earnings per share growth. And then the final part of the equation is what someone will pay you for the asset compared to what you paid for it. So that's that change in sentiment. If we look at an example, this is an example where we've bought a share for $1 and we're going to get a 4% income. So that's locked in. In relation to dividends and rent as well, if you're looking at property, the income you're going to get is fairly consistent. If we're buying a share today and it's giving us 4% dividend, most shares, and particularly when you look at it from a market perspective, it's reasonably consistent. So we can rely on that as being fairly accurate. In this case, we buy the share for $1. We're going to get 5% earnings growth in that share. And then also, the price of the share is going to rise, in this case by 7%. So that's that change in sentiment. So it goes from $16 originally up to $17.90, and that equates to a 16% return when we include our income. If we look at a more negative scenario though, where we still get our 4% income, in this case the earnings per share growth has fallen by 5%, And also, as a result, the sentiment might have made the share price fall as well significantly. And in this case, we're down 43% when we add up our income, our earnings growth negative figure, and our sentiment negative figure. So if we put that together in an example of a 10-year forecast, so I'm just going to focus on this table looking at the Australian shares, but the principle is the same for all those major asset classes that we've got in this table. So the Australian equities. As an example, if we're buying Australian equities today, we might be picking up about a 5.4% yield on that investment. Then in this case, our earnings per share growth between now and the next 10 years is actually a negative figure, reflecting the challenges the market's probably going to face in the next decade. However, from a valuation effect, we think the market's probably slightly undervalued at the moment, so you're going to get a uptick in that valuation effect. So when we add up our current yield, our earnings per share growth and our valuation effect, in this example, we're going to forecast that Australian shares in the next 10 years is going to give us a return of about 7.3%. That enables us to then compare that asset class with other asset classes in what we're going to expect to get return-wise, and it also then helps us to look at what a portfolio might look like. So in this example, we've just put together some hypothetical portfolios from conservative through to total growth. We've taken those returns on the previous slide and put that in the expected return. And then we've got different allocations from a conservative profile through to total growth profile. And the allocations vary whether you've got more shares, more fixed interest, more property. We can then put that together and we work out an expected return. So in this case, if I look at the growth profile, we expect a return of about 5.12% over the next 10 years. We can also then, though, look at the risk that these portfolios take. And so when you're looking at something like your superannuation and you're in a conservative profile or a balanced profile or a growth profile, you can get an understanding of what return you might expect to get over the next 10 plus years, but also an understanding of what risk you might be taking. In this case, if I look at that growth profile, a 1 in 20 year downturn could be around 20% of your portfolio, and a 1 in 50 year downturn, so something like the GFC, you might have lost over 35% of your portfolio. So we need to understand what return we're getting and also the risk we're taking when we're making those investment choices. And we also need to look at it in comparison to other asset classes. If I'm going to get 7% off Australian shares, but I can go and get 6 or 7% off a low risk fixed interest term deposit, then in that case, Australian shares aren't actually particularly good value because you're not getting rewarded for the risk you're taking. So when we look at the valuation of the asset classes, we're really wanting to compare to what we can get in a risk-free portfolio. So something like term deposits. If we're getting a good premium, so for example, if we're getting 7% in Australian shares, but we can only get 1 or 2% in a term deposit, then we're getting rewarded for the risk we're taking. So the objective today was to get you to understand what you're investing into in relation to asset classes, what that may look like from a return perspective, and what risk you may be taking in your portfolio. So next time you look at your superannuation statement, have a look at the profile. Don't get too caught up in the name of the profile. One person's balance fund can vary very differently from another person's balance fund. Have a look at the allocation. So if you're in a 50 to 60% allocation of growth products like Australian shares, property, then you're in a balanced or growth profile. If you're in 100% in growth assets like shares and property, you're in a total growth profile. So have a look at that and you'll have an understanding of what return you can expect, but also the risk you're taking. Next episodes in our series, we're going to start looking at retirement planning, and we'll then look at risk protection, estate planning, and other areas you need to consider depending on what stage of life you're at in relation to your money. Thank you. Goodbye.